Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. It's our 1-year anniversary at Macro Hive. Exactly a year ago, we launched our site and sent out our first set of exclusives and curated content that included blogs, academic papers, and podcasts. To mark the birthday, I've actually selected one of my favorite books and I'll be sending it out to all of our paid subscribers. Make sure that you've sent your address to us in case you haven't already. And I won't tell you the name of the book except to say that it was published in 1946. This week, we've also dropped our paywall so everyone can see the type of work we produce. It should be enough to persuade you to sign up to become a subscriber. It's only the cost of a few coffees a week, and with that, you'll get access to all of our exclusive content, summaries of academic papers, curated content, our Slack channel, and of course, the occasional gift in the post too. Now, onto our podcast show. On today's episode, we have Dominique Dwor-Frecaut. She's an accomplished macro strategist based in LA whose work I got to know last year, and I've drawn her into the Macro Hive network ever since. She has a fantastic background. She's been a strategist at several hedge funds, including Bridgewater. She's worked at the New York Fed, the IMF, and the World Bank. She's also worked at several banks, including Barclays Capital, ABN AMRO, and RBS. And to top all of that, she holds a PhD in economics from the London School of Economics. So she's very accomplished, as you will also tell from our conversation. Welcome, Dominique, to our podcast show. It's great to have you on.
Thank you for having me.
Well, the first thing I would say, Dominique, is that you're one of the few researchers I know who has been calling for a V-shape recovery very early on, especially when we started to see markets rally after the stabilization of COVID. Most people were trying to fade the recovery, talk about the various other letters, W, U-shape recoveries, L-shape recoveries, but you've been fairly firm in your view about the V-shape recovery. So maybe we can start with that. What was your thinking, or how have you been looking at the recovery? And if we maybe focus on the US to make things easier, how are you thinking about the recovery to make you confident that we would have a V-shape?
So I started to look at historical precedent, so previous episodes of high mortality, and whether this was the Spanish flu or the Hong Kong flu of the 1960s, or even in Russia, the post-Soviet collapse increase in mortality. I mean, obviously, these were all big human tragedies and people did die out in large numbers. But the impact on the economy wasn't that great. At the same time, what really struck me is that this was the first pandemic with social media. So from the outset, I thought that we would get panic epidemic propagated by social media as well as a true medical pandemic. And to me, the key question, whether this was an extinction event or not, was in the post-COVID world, would current business models be viable? Like, for instance, would a restaurant be able to reopen in the COVID world and still be able to break even? And I thought that for most businesses, the answer was yes, because on the one hand, I felt that the medical crisis was not as big as people were making it to be. Sure, mortality rates were higher than the common cold, but this was not the plague. This was not in the Middle Ages when 1/3 of the population was decimated by the bubonic plague. So there was that. Then also there was human ingenuity factor. And I remember my classes of economics when people were talking about the doom predictors of, when was it, the 1970s or something, the Club of Rome. There was a group of people who predicted that human civilization would get extinct by the 1990s. And basically, I thought this was just an example of a human bias towards linear thinking, so linear projection of current events. And I live in LA, so I'm just a few hundred miles south of Silicon Valley. And I thought that before COVID, people were so excited about technological revolution. And suddenly, all this excitement gave way to, in my view, extreme pessimism. So I thought basically that extinction events are not that frequent. Otherwise, they wouldn't be called extinction events. But there was an overreaction to this medical emergency, I think possibly because people find death and disease unacceptable, especially well-off, educated people in Western societies. And so it seemed to me that there was an overreaction from the public. And on the other hand, I saw the policy reaction, which was mind-blowing. I mean, basically, the Fed is prepared to underwrite most of the credit market, which is wow. And then if you compare the fiscal policy response now with GFC, where basically after 2010, the US went for pro-cyclical austerity. And this time around, we've had, I mean, each time I look, we get a higher number of the deficit. We've had absolutely gigantic fiscal stimulus. So the combination of these two factors is what made me confident on the shape of the recovery.
One of the things, though, is that we have had a lockdown, and that has resulted in businesses, including those restaurants that you mentioned, having to shut down, which could cause cash flow issues. And presumably there will be some scars that will be left from the lockdown, and there possibly could be some shifts in consumer behavior as well. So do you think that we can go back to the way things were before?
Definitely not, because as you said, there will be some scars, but sometimes scars are a good thing. When you have new constraints, for instance, new constraints on environmental impacts of how we make things, constraints on car emissions or car gas consumption, these are often turn out opportunities for private sector creativity, for people to come up with ways of meeting these new regulations and still coming out ahead. So, for instance, car becoming more gas efficient. And I think this could be another instance of this phenomenon. We're going to have a big rethink of how businesses function. I think the possibility of working from home has become much more acceptable thanks to the crisis. So businesses are going to be able to save on facilities costs. They will need fewer desks. So in a way, what this is going to do is to accelerate some trends that we had before COVID. So distance working, and in turn, it means that people can move, don't have to live so close to their work. They can move to cheaper areas that are further away from work. So I think we're going to see some productivity increases. Of course, there will be losers and winners, but that is the essence of capitalism. That this famous creative destruction process, we are going to see some of that, and it doesn't mean necessarily that we will be set back.
But what about all these terrible economic numbers that we're seeing? Huge collapses in GDP, massive surges in the unemployment rate around the world, including the US. Doesn't that tell us that something could go wrong here?
Plenty could go wrong. You're absolutely right. But I thought today's Micro Hive, you made a really good comparison between what's going on now and the Chinese New Year, when the whole of China goes on holiday. So what has been going on is that the economy was put to sleep voluntarily, which made for this absolutely unprecedented decline in numbers. But we have to put it in perspective. Just like the Chinese economy restarts after the Lunar New Year, I think we could have the same thing in the US. And the key here is to make sure that what is currently a liquidity crisis doesn't turn out a solvency crisis. Because one big difference, of course, between Chinese New Year and the shutdown is that the shutdown was not anticipated. So businesses didn't have the opportunity to prepare, pile up cash cushions, and so on and so forth. We do have a liquidity crisis. On the other hand, look at the Fed, look at the Paycheck Protection Program. That's basically giving free monies to SMEs. The Fed is buying fallen angels, is buying ETF of bonds that are below investment grade. I would argue that the policy response is commensurate to the risk. And to me, the overriding factor is the elections in November. And you have an administration that's going to do everything under its power to make sure the economy is well on its way to recovery before November.
The other subject or topic that many macro investors are thinking about, aside from shape of the recovery, is inflation. Obviously, we've had a prolonged period of low inflation, and there's a strong bias now for everyone to say that we're kind of following the path of Japan. What's your sense on the path of inflation going forward?
So before COVID, I used to be with the consensus that inflation was stuck. But I think COVID is going to be a trigger, not COVID itself, but perhaps a policy response to COVID, political and social impact. In my view, it could well be a trigger for a resumption of inflation. Not so much because of the enormous stimulus that is still filtering through to the economy, because in a way, this is a one-off. Once the economy is well underway to recovery, the stimulus will be tapered. So even if we have a little bit of a burst of inflation because, the businesses we were talking about are increasing prices to recoup part of the higher cost imposed by the post-COVID model. And then you have all these pent-up demands that you see with the recent increase in bank deposit, in money market fund. People are saving. They are very risk averse, but as the recovery gets underway, the US consumer will find back its mojo and that money will get spent. So we could have a little bit of a spike in inflation there, or recovery in inflation, certainly from a very low current level. But longer term, I'm actually thinking that we could have a change in inflation regime. Because to me, the low inflation we had before COVID largely reflects basically workers' loss of market power. Because when you think about it, and as Governor Kuroda told us, to have sustained inflation, you need a wage price spiral. So you need producers and workers fighting it out in a way in the labor market and in the goods market. And the wage price spiral, in my view, has been progressively broken since the 1990s, with basically workers losing bargaining power to technology, to globalization, to, in the US, anti-union legislation. Because the bottom line is, if you look at the labor market, and before COVID, we had unemployment at a 50-year low and not much growth in wages. What this is really telling you is that workers don't have much bargaining power. The reason for the loss of bargaining power that I just mentioned, I think they are very well known, but I think there are other reasons that investors are not focusing on and that they should pay more attention to. And to me, one of these key other reasons is the fact that the US goods market has become less and less competitive. You've had concentration in just about every industry. And I think there is awareness of that, but there is not enough awareness of the impact it is having on wages and inflation. Because when you have this concentration on the goods market, it means not only that workers have fewer employers to choose from, and by the way, there has been academic studies showing that in US counties where there is more economic concentration, wage growth is slower. So not only there are fewer employers that you can set against one another to extract higher wages, but it also means that those employers that are also selling goods have more market powers than workers. So in other words, they have more power in setting up prices than workers have in setting up wages. So the result of that is you get no increase in wages and the share of labor in national income goes down. So demand is weak, and that makes for sluggish growth, sluggish inflation. And of course, another additional factor that I think we are only starting to pay attention to is income inequality, because income inequality means that growth in income is going mainly to high income households who have higher propensity to save than low income households. So it means that the growth in income is fueling basically the demand for financial assets rather than the demand for goods and services. So again, this makes for an economy with weak demand growth, weak goods price inflation, but strong asset price inflation. And in fact, this is something I've been thinking about for a number of years. And what's interesting is that there is a new academic paper by Mian and Sufi, who wrote a lot about the impact of household balance sheet on the crisis. So they've written a formal mathematical model that just shows what I've been describing. So why do I think it could change? Because there were some undercurrents before COVID that are coming to the fore because of the pressure that COVID is putting on low-income households, on the politics, and generally on new social awareness that we have in the US. I think that even before COVID, you could see US politics moving to the left. And I think COVID and also the abominable death of George Floyd has made that even more obvious. You've had really generous unemployment benefits voted by the Republicans. The Republicans are even considering crafting their own rules to reform the police in the aftermath of the murder of George Floyd. This is unbelievable. I mean, for the US, this is truly a revolution. So we have a change in politics that supports workers getting more power. Then there is this whole economic nationalism, reshoring, caps on immigration, deglobalization. That could also increase the bargaining power of labor in the US. And then the other thing that is happening is that you are starting to get some pushback against monopolies. And even the GOP is starting to participate in that. I mean, the most obvious pushback is against large tech, for political reasons as well. But more broadly, you're starting to read the Wall Street Journal, in the Financial Times, you're seeing some Fed papers questioning the impact of this monopolization of the US economy and basically questioning the conservative doctrine of the 80s that bigger meant more efficient and was good for the US economy. So for all these reasons, I suspect we may be on the cusp of a change in inflation regime.
Interestingly, you didn't emphasize the growth in the central bank's balance sheet or printing money. I mean, lots of people, especially in the investment community, talk a lot about how central banks are printing money. MMT, modern monetary theory, and all those sorts of things has been a big spur for inflation. Why do you not think that channel could be a contributor?
Two reasons. The first reason is that we are talking, I think, more about one-off than a growth rate. So if you look, for instance, at the growth in Fed assets, there was a huge spike in March, April, and then it's been flattish. So for one necessary but not sufficient, and I'll come back to that condition, would be that it's not the level of the Fed asset that goes up, but the growth rate. And I don't think we are there yet. We could, but we're not there yet. And then the second reason why I don't see this as a key factor is basically the transmission of monetary policy. So first of all, so what we've had is an increase in base money, right, in the Fed liabilities. And that increase in base money has not just same happened, by the way, after the crisis. It did not translate in a big increase in credit yet. Okay, early days. But here is why I don't think it's going to translate in a big increase in credit. Because on the part of a household, they are saving like crazy. The household savings rate in the US is 30% right now. I mean, it's going to come down. but I don't see the household going on a huge debt binge. On the corporate sector side, investment demand is down, and investment demand tends to be a lagging indicator. So I'm very much believer in the accelerator theory of investments, that you need the output gap to disappear before firms start putting up money to build new facilities. And also, if you take a long run look at how firms have used corporate leverage, they've actually used it much more to buy financial assets than to buy economic real assets, machineries, and so on and so forth. So I see more of a chance at the moment for this big buildup in base money to fuel financial asset price inflation than goods price inflation. Though in general, as I said, I think we could be on the cusp of a change. I mean, obviously, I'm not going to predict inflation going to 10% tomorrow, but I am looking at the data very closely for signs that things are changing.
Let's shift focus a bit. Obviously, China was the first one to suffer from COVID. It's come out of COVID first as well, so its economy is recovering somewhat. At the same time, we have this ongoing US-China trade war, geopolitical war, Cold War. It's hard to describe exactly what it is, but it's opened up on multiple fronts. How do you see the Chinese economy and relations between China and the US?
So again, I think it seems to me that it's another instance of COVID acting as a trigger and as an accelerator of trends that were existing before. On the Chinese side, you had the issue of the middle income trap. In fact, I wrote a quick note, which you kindly published in November, showing that the Chinese GDP data didn't make any sense because it suggested a very fast growth rate of productivity, which was completely unrealistic. So, and also you had China struggling to keep its enormous share of global exports of goods. So you had this middle income trap that they were trying to escape. And then the other trend was basically the West rethinking its relationship with China. I mean, you know, the US was happy to support China's entry in the WTO, in part as a quid pro quo for China not devaluing during the 1997 crisis. I think there was this convergence of interest between the Chinese elite and the Western elite, where globalization built up China at the same time, increased the share of profits in GDP in Western countries because it was a big contributor to decreasing the market power of workers, as I was mentioning earlier. So for a couple of decades, we had convergence of interests. And now the interests are not convergent anymore. And I think it's because China has become more of a competitor economically. So for instance, we have all these issues with China trying to break into exports of high value added goods, sometimes with intellectual property that was not quite acquired in a very transparent ways. You also have financial rivalry. China is trying to internationalize its currency, steal some of the global seigneurage. You have geopolitical rivalry. So China is becoming more of a competitor. And also, I think on the Western side of things, there is more of an awareness of the risk of allowing transfers of advanced technology to a country that doesn't share the values of the West on democracy, the rule of law, free markets, and so on and so forth. So you've had this sort of a long-term trend in the backdrop, and then you have COVID, which I think is putting political pressure both on President Xi and President Trump. I mean, China's labor market is not in great shape. The essence of the social compact in China, in my view, is that Chinese citizens give up their democratic right, and in exchange, they'll receive economic security from the government. And so the system is really not geared up for a loss of employment, which seems to be what's happening in China. And on the US side, clearly, President Trump was planning to campaign on the strength of the economy and of the stock market, of course, and he cannot anymore because of COVID. So all this makes the sort of underlying tensions become more apparent and also become stronger. And we are entering a long-term area of decoupling. I mean, I'm certainly not expecting World War III, but of much tighter control over exports of technology, over China becoming more important in the economy of Western countries. There is a pushback that's going to last for quite a while. And it seems to me that one of the possible early casualty of this pushback could be the Hong Kong dollar. That basically Hong Kong is not as important as it used to be to the mainland, because the mainland has deepened its financial market, its financial infrastructure. Also, Hong Kong is about to lose its preferential access to US technology. And at the same time, when you think about it, the Hong Kong peg is promoting the global role of the dollar when China wants to promote the global role of its own currency. Add to that a Chinese leader who is very nationalistic, having all these domestic difficulties when next year you have the centennial of the Chinese Communist Party. He needs a win before that anniversary. And the win could, from his perspective, could very well be repegging of the Hong Kong dollar to the CNY, which, by the way, would also penalize Western interest in Hong Kong.
Yeah, that's quite a big risk there, which you point out, which could be an interesting way of thinking about Hong Kong, because I think a lot of people look at the Hong Kong dollar from a purely economics perspective in terms of is the peg or the currency more sustainable from a macro perspective, whereas I think looking at it from a political or geopolitical perspective is probably the more appropriate way of looking at its sustainability in that filter. And we haven't talked much about Europe. Obviously, a lot has been going on in Europe. You know, recently we've had the news about the EU Recovery Fund. We've had some news about Germany finally doing some fiscal stimulus. At the same time, COVID has hit some of the southern European countries quite hard, Italy and Spain in particular. What's your take on the state of the European economy and then also the Eurozone as a whole?
I was joking that I am a passport carrying European. I certainly feel very European. I have, dual French and US nationality, but I'm afraid I was never much a believer in the euro. I think the Eurozone was never an optimal currency zone. The euro was set up by politicians for historical reasons. And there is this view among the establishment that the euro is what has prevented World War III, which personally I think is very sloppy thinking. So this drives my perspective on the European Recovery Fund. It has to be implemented. I'm also wondering, why is this an EU fund rather than a Eurozone fund? Because the more players you get, the more complicated it is. And that's a problem I have in general with European institutions, is that the institutional integration, in my view, was far ahead of the economic integration. And that makes for an enormous degree of complexity and a terribly inefficient decision-making process. So I certainly wish Europe well, and I hope, this fund works. I'm also delighted to see that the Germans are reconsidering their aversion to fiscal stimulus. I'm a little amused that as long as it was others in need of fiscal stimulus, the Germans thought this was a terrible idea. But now that their own economy is facing a demand deficit, they are certainly taking another look at the question. So I hope that, their conversion to fiscal pump priming will last beyond the COVID epidemic, because I see the European austerity as perhaps a key driver of the underperformance of the Eurozone. So in a way, Europeans, I agree with the traditional establishment view that Europe makes progress when there is a crisis, which was Jacques Delors' view and has been repeated by every leader ever since. I just hope the crisis doesn't get so big that no progress can arrest it. We're not there. I think that COVID has bought time precisely because it's allowed more fiscal expansion. But I think there are, again, some long-term undercurrents, some long-term issues that haven't been resolved. To me, one of those issues is Italy. I mean, if you look at the economic performance of Italy, I believe they still haven't recovered their GDP from before the crisis. This is a country that structurally is not suited to have a peg with Germany. And it's starting to show in the politics. You're starting to have, a very broad, growing support for the extreme right. And that's anti-Euro, even though they won't say so very explicitly. Again, COVID has kind of stopped the progression of the extreme right, but the underlying reason, which is mediocre economic performance, poverty, unemployment, have not gone away. And similarly, what we've had in Germany is so not only COVID has brought about this miraculous, transformation of German policymakers and their newfound belief in fiscal expansion, but it's given more room to the CDU. I mean, before COVID, the CDU had lost a lot of ground to the Greens, and you have to give this to Angela Merkel. Her handling of COVID was probably one of the most efficient in the world. So you've had a jump in her popularity and in the popularity of the CDU, which means that extreme right parties such as AfD that were prevalent in the old Eastern states, which again have never really thrived after reunification, AfD's progression has been stopped. So it's funny because in a way, in other parts of the world, you see COVID as a trigger to bring in the open underlying weaknesses. In the case of Europe, COVID is more of a trigger to keep things going a little bit longer, even though the underlying weaknesses are still there.
If anything, that kind of helps support your optimistic view on the world.
Paradoxically, yes.
I think we've covered lots of topics here. We've gone through the US, China, Europe. We've talked about inflation. Are there any other topics that you think we should talk about before we wrap up?
To me, in a way, the biggest long-term issue for investors is whether we are shifting inflation regime. Because the reason we've had a Fed put, the reason we have had TINA, the reason equities still look cheap now is because we have no inflation. Inflation comes back, the Fed has to tighten, bond yields go up, just when the US government is issuing massive amounts, which it is starting to term out. This is not a good combination. So as an investor, I would really be looking for signs that we are indeed changing regime.
If you were forced to give a probability of a higher inflation regime, say in the next 2-3 years, what probability would you assign to that?
55%.
55%, okay. So you're kind of leaning that way, but you're not willing to put all your chips in.
You know the joke about the clock that is stopped and is right in the right time twice a day. So if you have to mark things to market every day, a sort of a 2-year view is perhaps not helpful. Where I think having that sort of framework is helpful is to put you on the lookout for signs that things are changing. So that's how I would look at it. So at the moment, I'm still thinking that equities have more upside. We are in the sweet spot for the recovery because growth is picking up, inflation is still very subdued. Then you have this enormous accumulation of a short-term asset. As I mentioned, the 2 trillion increase in a bank deposit, the 1 trillion increase in money market fund, the treasury account at the Fed, I believe, is now 1.4 trillion, so 600 billion above the new minimum set by the Treasury. So all that is going to flow out in the equity markets at some point. I mean, given that you have the Fed that is basically going to prevent any large-scale bankruptcy, some of that money is going to go to the equity market. So short term, I'm still very bullish, but longer term, it's a completely different story.
Okay, well, I think on that note, we can wrap up the conversation. So thank you very much. One thing I wanted to ask is if people wanted to follow your work or your thinking, what's the best way for people to follow your work?
Thank you for asking that. The best way to follow my work is to subscribe to Hive, the best research platform out there.
Great. Okay, that's excellent. Well, on that nice note there, we can wrap up the conversation. So just once again, thank you very much for your very enlightening words of wisdom.
Thank you.
Speak soon. Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.